Good afternoon, everyone. Let's get started with today's webinar. Thank you all for being here. Just a quick note that the webinar today is being recorded. And I'm doing that right now, as well as situating some of the panels on my screen. Okay. I think it's about time to get started. So let's do that. Good afternoon again, everyone. Welcome to today's webinar titled Momentum versus Valuation, Making Sense of Markets. We'll be doing something a little different today compared to our previous webinars, and also in terms of content, which is to say that the objective of today's presentation is to explain how markets impacted mid-cap growth investors over the last year, as well as the first quarter of 2016. We're going to do that by looking specifically at the impact of markets on the Azzad Ethical Fund toward the end of our time today. Think of it as sort of a recap of the past several months, complete with a breakdown of the major drivers of investment returns, along with a look at how previous trends like price momentum seem to be possibly breaking down in favor of more conventional valuation metrics. So moving right along here, take a look at the lineup for today. Joining us for this afternoon are Christian Greiner, Vice President at Ziegler Capital Management out of Chicago, and Portfolio Manager for the Azzad Ethical Fund, our mid-cap growth mutual fund. And I'm Josh Brockwell, Investment Communications Director here at Azzad. We're going to start things off today by looking at the most common factors that can drive investment returns, specifically price momentum. And let me start out by saying that 2015 was a trying year for the Azzad Ethical Fund. We acknowledge that. The fund found itself in some names that had fallen out of favor in the market, despite having some compelling future prospects and attractive valuations when compared to some other peers in the mid-cap growth universe. As the year went on, it became increasingly clear that this was a year that was going to be one whose return was driven primarily by one factor, which is price momentum, and that's the reason or occasion for today's webinar. And we're going to turn it over to Christian Greiner at Ziegler Capital Management right now to walk us through this and help us better understand what price momentum is, if it's going to continue to affect markets, specifically the Azzad Ethical Fund, or not going forward. So Christian, let me bring you in here. Can you hear us?
Yes, I can, Josh. Can you see me?
Yeah, coming through loud and clear and looking good. Welcome aboard.
Well, thanks for that introduction, Josh. So let's talk a little bit about price momentum. And what exactly is price momentum? Price momentum is one of the most common factors that can drive investment returns. In simple terms, it's the concept that stocks that have moved higher in the recent past will continue to move higher in the future. And price momentum can be looked at from the short-term perspective, be it 1 or 2 weeks, or longer-term perspective, 9 months, 12 months. In 2015, the argument over price momentum took shape with the financial media's fascination with a group of stocks, which we call the FANG stocks. And that, of course, stands for Facebook, Amazon, Netflix, and what was then Google. It's now, of course, called Alphabet. These stocks continue the rise with little regard really to market conditions, and in the case of Netflix and Amazon, with really little regards to traditional valuation metrics like price to earnings ratios. So these stocks, they took a nice first quarter return in 2015 and continued to build as the year went on, dwarfing the flat returns for the broader stock indices, as we can see on the slide here. For some large cap funds, their year may have hinged upon if they own these 4 names or if they didn't.
Okay.
So price momentum is one of the most robust factors when you take a look through the history of factors. And that means that when it works, it really tends to continue for long stretches of time. Indeed, there's evidence that the stretch from that bottom that we saw in spring of 2009 until now has really been one of the best times ever for price momentum, with only 4 rather shallow bumps in the road for its returns as we've gone along here over the last 6 or 7 years. However, when price momentum breaks down, the sell-off in these momentum names can be quick, and it often catches some investors unaware. So we can illustrate this by taking a look at stock market returns from what we call a factor perspective.
Okay.
So what we see here is another way of looking at returns. And what we're seeing is a grouping of some of the underlying characteristics of stocks. And you can think of these as factors that each stock is exposed to in one way or another. And indeed, some of these make sense that you've heard of before. We just, of course, talked about price momentum. With earnings quality, we're talking about stocks that have a relatively clean quarter-to-quarter earnings. That means they don't have a lot of special items or footnotes that you have to go through to see what the true earnings power of the stock was during that quarter. So as we have a glossary in the back that covers each of these factor groups in detail. But one of the more interesting way of taking a look at new investment products is that there are some investment products out there right now that try to focus on these particular factors. So one particular factor might be focused in on, or there's products that go in there and they shift from factor to factor, thinking whatever factor will be the best performing in the future will shift over to that. And the way that they do that is that they invest in stocks that are highly exposed to these factors. And they take a look at this through past returns and taking a look through statistical analysis to see how a stock is exposed to these particular factors. And so one way to think about this is the way that they do this, and the way that we come up with these numbers here is that we take a look at this from what we call a long-short portfolio perspective. And in that, we rank individual stocks by exposures to the characteristics of one particular factor at the start of the quarter. And then we take an equally weighted portfolio made up of the 20% of stocks with the highest exposure to that factor, and then we subtract the return of an equally weighted portfolio return of the stocks with the lowest exposure to that factor, usually at another 20%. And so this long-short return serves as a measure of performance for that factor for that particular quarter. And that's what we see here on this particular screen. So when we take a look at 2015, a couple patterns stick out here. The first is that price momentum in the green there at the bottom of the screen had an extremely good 2015, having positive factor performance all 4 quarters, and was one of the best performing factors, and was indeed the best performing factor in each of those quarters.
Okay, so Christian, last year, as we acknowledged, was a challenging one for valuation, as we saw with those negative factor returns in each quarter for 2015. So let's talk about how that, i.e. valuation, differs from momentum.
Well, valuation is really a lot of the familiar factors people look at when they're first looking to buy a stock. And some of these will sound familiar to most investors. Price-to-book measure, price-to-earnings ratios, dividend yield. Our process likes to take a look at earnings, but we also take a look at price-to-cash flow metrics because our work has shown that in the past, that's a clear indicator of long-term shareholder value. And at this point, it would probably be prudent to mention that valuation and price momentum are not polar opposites. It just might seem that way when we take a look at those numbers that we just did. There are times when stocks with attractive valuations have good price momentum. Often during the early stages of a stock market recovery, this will be the case. It's really in times like these, when we're in a bull market that's been underway for a good while, that the valuation momentum quandary may seem like an either-or proposal. So with the Azzad Ethical Fund, we like to take a diversified approach. And we have a mix of stocks. We're going to have some stocks that are highly exposed to the price momentum factor, especially if we just hold on to our past winners. The portfolio will also have stocks that are exposed to some of the other factors that we saw. We have stocks that have good historical growth rates, and we also have ones that have analyst expectations of future attractive growth rates. And of course, we also have stocks that score highly on valuation.
Okay, now we started to see a breakdown, as I mentioned, in the momentum trends in the first quarter. Can you talk about that in a little more detail?
Well, sure. So let's take a look at these factors again, this time for the first quarter of 2016. And as we can see, price momentum very quickly went from being the best performing factor to the worst performing factor. As it stood at the end of the quarter, this would be one of the most intense sell-offs in momentum in the past 30 years, and the most intense that we've seen since 2002. To illustrate this further, let's go take a look at how that Bang portfolio we showed earlier, how that fared in the first quarter of 2016. So indeed, it looks like there was a slight change here in market sentiment. Taking a look at these returns, Facebook outperformed on the back of strong earnings, while the other three underperformed the broader market.
Okay, Christian. So let's conclude with a brief comment about the impact of these market dynamics, specifically on the Azzad Ethical Fund, ticker symbol ADJEX.
Well, the Azzad Ethical Fund is managed in a risk-conscious measure. We realize that our rigorously ethically screened portfolio will cause some deviation between us and our broader market benchmark. Still, we maintain a 2.5% tracking error to that broader benchmark, and we do that for good reason. And we do this in part by not loading onto one factor or another. We try not to let the portfolio be dominated by an exposure to price momentum or allow it to become too focused on valuation or really any other factor for that matter. We stay firmly within the mid-cap growth mandate, and our Morningstar style box profile will show that. When one factor has a massive outperformance for an extended period of time, like what we saw in 2015, managers that have high exposure to that factor will tend to have good returns to the benchmark. They're being compensated for that risk they're taking to that exposure. However, when we see a turnaround in factor performance, like what we saw in the first quarter of 2016, many of those same managers will have periods of underperformance tied to that exposure that was working so well for them previously. We saw that in the first quarter. The swings in market leadership were quick, hurting the performance of many funds, and the ending tally for the first quarter demonstrated that. The benchmark for the mid-cap growth space beat 80% of actively managed funds, making it an especially tough quarter for active managers. The ethical funds return beat about 75% of its peers for the mid-cap growth space in the first quarter of 2016. And we're pleased with that. Our focus is on quality long-term businesses, and we believe that should help us in times of market uncertainty. As 2016 moves forward, we're presented with a U.S. market facing uncertainty over earnings growth, to say the least. That scarcity of earnings growth means that quality growth stories should be in demand. And that's really where we want our focus to be with our portfolio.
Okay, so with that, as you mentioned, Christian, there is a list now on your screen of key terms, specifically broader definitions of those factor groupings that Christian was outlining earlier. I actually want to, at this point, since we've finished with the bulk of the presentation, and I wanted a lot of this to sort of be a healthy conversation, back and forth Q&A with you, Christian, if you don't mind maybe taking a few questions from the attendees today.
Oh, no problem at all.
Good, good. Okay, so with that then, we can open it up to questions from the audience. If you'd like to ask Christian a question, you can do so by using that question box on your GoToWebinar profile panel or control panel. What I'm going to do, though, is kick things off, Christian, if you don't mind, with a question that's actually a follow-up from a webinar that we did a month or so ago on the earnings recession that we seem to be in at this point. And for those of you who are interested, it's up on our YouTube page. Check it out. We talked about the fact that companies have been going through a period of negative earnings growth now for a few quarters. So we've seen these multiple quarters of negative earnings growth, Christian, and a lot of times people talk about or project that an earnings recession may be the precursor to a greater economic recession, and just want to kind of get your rejoinder to that.
Well, you know, a lot of times that is the case, that you'll see earnings start to go south, and an economic recession, if it isn't already underway, come to be in probably 6 to 9 months after we see that earnings recession. When we take a look at the broader economic data, though, we're just not seeing that recession. We're probably seeing some of the more of the same, and that's this sluggish growth. Part of it's being brought on by the monetary and fiscal policies that we see here in the U.S., but really also abroad, where we're going to see slow, sluggish, steady growth. We're not going to see a lot of inflation, and the investment returns tend to reflect that reality. When we take a look at some of the broader economic measures here, we're seeing a slow services economy here in the U.S., but it's growing. Manufacturing is recovering a bit, actually, from the effects of the strong dollar that we saw in 2015. And we're still seeing a relatively strong demand for automobiles and a strong demand for housing. If we were going to be seeing the economy turning over, we would be seeing some problems there. And we would also probably be seeing a little bit more problems in the job market. We're approaching full employment now, if we haven't reached it already, but we're still seeing some slack in what's called the U6 unemployment rate. Those are the people that are unemployed, plus those that are looking for full-time work and are working part-time right now. That's still coming down. So once we see that unemployment rate start to tick back up, maybe we'd be more concerned about a recession then as well.
Okay, thank you. Very thorough response. Just going through the other questions here, I see one relevant to the content of today's presentation, so let me prioritize that one first. And it involves the notion of momentum again, and it says the market seems to be ignoring fundamentals, paying for momentum. What do you think caused this, and what do you think will cause fundamentals and valuation to reconnect?
Well, that is a good question, really. That's the $64,000 question. There's pretty much any time within the market that you could say that the market is ignoring one fundamental or another, and I think usually when people are talking about this, they're talking about the relatively high PE ratio that we see in the market right now, and that's a concern, especially when you take a look at some of that languishing earnings growth that we were talking about. So what would it take for us to reconnect to that? It would probably take a little bit of a market downturn, or a little bit of a scare on the economic front, where people would say, where is the actual value in my investments? You know, where we start taking a look at what we talked about before. You know, cash flows do matter, earnings do matter, quality earnings matter. One thing that's sort of reached the public lately is we talked a little bit about earnings quality. Companies are, the earnings quality is starting to degrade. You know, we're seeing what they call non-GAAP earnings, you know, generally accepted accounting principles. The difference between that and the earnings that companies want you to look at, the non-GAAP earnings, is growing. So we would, you know, take a look at that and say, once again, fundamentals do matter, and in pretty much any market. But what it's going to take is a little bit of snap back at some of these measures here.
Okay, very good. Thanks. Another question here I see relates to specifically the Azzad Ethical Fund. Just a question, kind of a broad one, about when you expect to see a recovery. I know we mentioned earlier that the Azzad Ethical Fund beat about 75% of its peers in the mid-cap growth universe, but still, everybody wants to know the future. So I'm not expecting you to make any projections here, because as they say, he who looks into a crystal ball eats glass, right? So we're not going down that road, but just any thoughts on maybe longer-term prospects for the fund in light of this maybe break away from momentum more toward valuation?
Well, we do look at valuation, but we also do take a look at momentum. And as we said earlier within this presentation, we were in some areas and some stocks that fell out of favor. We were looking for a little bit more of growth out of our retail holdings in 2015. What we did towards the end of the year is that we refocused our portfolio on certain areas of growth within the consumer discretionary space. And we're hoping that these are once again long-term drivers and long-term drivers of gains for us. We know that at some point quality does matter and cash flows do matter. And we're looking for the market to realize that and understand that. We're also in a point in the market that companies are rewarded for taking on debt. We're seeing that as a theme. Sooner or later, that particular regime will pass, and our companies, which of course are not loaded up on debt, hopefully will fall back into favor with investors.
That ties into the next question I was going to ask you, which was regarding the ethical screens possibly affecting the performance of the fund, and where you saw maybe the most impact on the fund, which screens in particular hindered performance. It sounds like heavily indebted companies. Our debt to market cap ratio criteria might have had an impact there.
And that is times. There are times when we do have to sell a stock that we hold because of those particular screens, and there's times when there are attractive stocks that just fall outside of what we could hold. And but overall, what we've seen with the screens is that they serve as a tailwind for us in the long term of pushing us towards quality. And part of that is of course, the long-term performance of stocks that are not burdened by a high debt load. Recently we put on screens within the fund to get out of fracking, and plus taking a look at the energy space. We got rid of our energy holdings as a way of making our portfolio a little bit more ethical in a way. So we take a look at these, but overall you can find quality stocks in any market, and that's what we're trying to do.
And on the subject of energy, I had another question here about the price of oil and the fact that oil and equities have kind of moved in lockstep over the past several months, and just curious what the degree to which you think this might continue, and how much of a factor oil prices have been in driving stocks one way or the other.
Well, right now, stocks and oil are seen as being on the sort of risk-on side of the ledger. So portfolio managers or investors want to increase their risk, or if they think that it's a risk-on environment per se, they're going to be going into oil, and they're going to be going into stocks. Now, there are times within a market cycle where the price of oil serves as a deterrent to future economic activity. If you're paying more at the gas pump, you're not going and buying more things at the store, and that's reflected in consumer discretionary stocks. There's also times when maybe the price of oil deters further investment for companies in other areas. They're paying so much for their gasoline or their fuel, or what goes into their particular, the energy inputs that go into their products, that it would affect something like, say, the industrial sector. So right now, the price of oil isn't serving as a deterrent to economic activity, so that's why oil and stocks are sort of moving together right now.
Just had a question here regarding, again, going back to the Azzad Ethical Fund's performance compared to, well, actually, this isn't a question about the fund's performance compared to its peers. It's compared to another fund with comparable screens, but in a different part of the Morningstar style box. So I don't know. Maybe you want to handle that, Christian. Maybe talk. I know you also, for separately managed accounts, you handled the the large growth side of the ledger too. So you want to talk about maybe how mid cap stacks up against large cap on the growth side?
Well, you know that they are different universes. Of course, there's a point where they blend together a little bit, and every mid-cap portfolio will probably have a few large-cap names, and every large-cap portfolio will probably have a few mid-cap names. So this particular fund that you're talking about, they too, if I'm thinking of the right fund, they too have had a trying time over the last couple of years with some of their performance within that space. And for them, they're coming up against some of the same problems that we do, and that is that especially really in the large cap universe, the cost of debt when you go out and you sell debt and lever up your balance sheet is so low that the market rewards that. And for larger cap stocks, of course, the cost of debt's going to be even lower than they are for mid cap stocks, but still some of the same dynamic that we're seeing and some of the same pain that we're seeing. You know, our particular investment style's a little bit different than them. I won't comment too much on that further than that, but you know, those are some of the problems, the common problems that we see.
Yeah, interesting. Okay, I want to, in the few minutes that we have left, I want to maybe broaden the universe a little bit, and we'll probably conclude with this unless there are any more really pressing questions. But I wanted to kind of pick your brain, Christian. You probably saw this McKinsey report that came out regarding millennials. That was big. The big headline was that they're going to have to work, you know, several years longer than most folks, either boomers or Gen Xers, and they're going to have to save tons more in order to meet their expenses and needs in retirement. And they attribute this to the fact that over the last 30 years, we've kind of had this, I used the phrase earlier in a conversation with a colleague, this Goldilocks economy, right? So we've had relatively low interest rates, we've had pretty good growth, productivity's been good, and this McKinsey report is projecting that those arrows are going to start to turn the other way. So interest rates really have nowhere to go but up. Growth is looking much more modest in the United States and Western Europe, and productivity is not great either. So what do you make of the report? How true is it, and what lessons can we take away from it?
Well, I think those were some of the same complaints that were heard, you know, 15 years ago when I was a Generation Xer and coming out in, you know, in early 2000s after the tech bubble crash. You know, you're going to have to save more to make up for this particular issue with the market.
Good point.
The way that I look at it is that for a millennial, and let's say that the average age of your millennial now is, I believe, 27, 28, the way that we define the cohort, they still have several market cycles ahead of them. That means you're going to have times when there are high interest rates and low investment returns and low productivity, but you're also going to have times when market returns are elevated. And the best way to think about this is that you just have to keep a steady view of your investments. And that is invest for the long term, invest in quality, take a look at prudent risks. Take a look at prudent risks and go from there. And you know, what you have to do is make sure that your long-term goals and your medium-term goals are being funded on a concurrent timeline.
Okay, appreciate it. Sounds like you might have other meetings and other things to attend to, so we might want to end it right there. We're going to conclude. It's I think been about half an hour. So with that, we'll end, guys. Thanks everybody for your time. I want to thank again Christian Greiner from Ziegler Capital Management for being with us today. Just a reminder to visit our website, azzadfunds.com, where you can download your free copy of the prospectus for the Azzad Ethical Fund, which we featured today. The prospectus contains more information about the fund's risks, expenses, and investment strategy. While you're there, you can also sign up to receive our monthly e-newsletter. to get more information about our financial products and services. Finally, be sure to follow us on Twitter. The handle is @Azzad Funds, and like our Facebook page, facebook.com/Azzad Funds. Let me also note that a recorded version of today's presentation will be posted to our YouTube page, which is youtube.com/Azzad Funds very soon. So be sure to take a look. Thanks, everybody, for your time. Have a great afternoon, and thanks again, Christian.
Thank you.